Welcome to my YouTube channel. So today class I'll be talking about still on currency, the last part of currency. So I'll be talking about how we denote currency. As I said in my last videos, in my last class. So as I said, well, we mostly use Greek letters to denote currency. Like for example, when you talk about United States of America, we mostly use what? USD. So when you hear about USD, know that it is representing United States of America dollar, because we use three big capital letters to denote currency. Like for example, you have euro, so you are going to have EUR. If you have Great British Pound, you are going to have GBP. So we use three letters in cap to denote that particular currency. But and now I know that you may be asking me that what are the different currency pairs that you can therefore trade? And I said, let's say in the Forex market, we're going to have like three broad groups of currency pairs. So we're going to have the major currency pairs, we're also going to have the minor currency pairs, and also the exotic currency pairs. So as a good trader, for you to be profitable in this market, these are some of the basics that you need to understand. So you must understand what are major currency pairs, what are minor currency pairs, and also what are exotic currency pairs. So I will start with the first one, the minor currency pairs. And as I said, the minor currency pairs are among the major currencies that I did mention in my last video. So as I said, when a major currency is being paired with the United States dollar, it is being considered as a major currency pair. Like for example, if you pair USD against Great British Pound, if you pair USD against Japanese yen, if you pair USD against euro, so it becomes a major currency pair. So we're also going to have some ones called like a minor currency pair. So a minor currency pair is when you pair a major currency now with another major currency without pairing it now with the United States dollar. So we consider that one as a minor currency pair. Like, and a good example can be, you can therefore have euro against Japanese yen, euro against Australian dollar, euro against New Zealand dollar. So those are examples of minor currency pairs. And now for exotic currency pairs. So for exotic currency pairs, these are those currencies that we hardly use in international transactions, that hardly been used in international transactions. And a good example of an exotic currency pair can be South Rand paired with the Turkish lira. You can also have the naira, the Nigerian naira being paired with the Zimbabwean pound. You can also have things like the Japanese, you can also have something like the Japanese yen being paired with something like the Russian ruble. So those are minor currency pairs. So as I said, so the key takeaway to know about the minor currency pairs is that they are hardly being used in international transactions, in international payment, in international transfers between the willing buyer and the willing seller. But in Forex, the reason why we always trade the major and the minor currency pairs apart, not the exotic currency pairs, is because, for example, when I say for the major currency pairs, so the first reason is that those are because they are mostly used in international trade. That's the first point. The second reason is that they are highly active. They are very, very active. And the third reason is that since they are mostly used in international trade, they are going to require what? They are going to require now low transaction costs, because the volumes of trade that do takes place using these major or minor currencies are too huge. And that's why, since they have huge volumes of trade on daily basis, so they are instead going to recover what? A lower transaction cost. Now, transaction cost is just that fee that you pay in order to access the financial market. So we call it a transaction cost. And for those coins, for those of you guys who have been trading a lot, so you discover that there are some pairs that before getting to the market, you pay higher fees compared to some particular trade. So the more a particular currency is very, very active, the more a particular trade now, the more a particular pair is very, very voluminous, you're actually going to pay a low transaction fee. And those are the cases now with the major and the minor currency pairs. Now, but if a currency pair is an exotic currency pair, you're going to discover that what? It's going to be, in fact, it's going to be less active. It's also going to be a lot less voluminous, because they're having less trades in the financial market. It's also going to have a very, very high transaction cost. It's going to have a very high transaction cost, because since less trades are being taking place using that particular currency pair, so you're actually going to spend more money, because those people also need to take more. Freight need to take place. So to access that particular financial market, you also need to pay more. You also need to pay more transaction costs on that particular currency or pair.